Good night, everybody. Today's the 21st of June, 2017. Tonight's webinar is entitled Understanding Trading Timeframes. Um, a lot of people ask me this question over and over, and I feel like I needed to do a webinar on it because people ask me, well, what's the best time frame to trade? And I always have a difference of opinions based on that person's individual personality. I feel like there are different personalities for every type of trading style, and there are different personalities for every type of trading time frame. Now, when we think about trading time frame itself, we're thinking about this here. We're thinking about the 5-minute chart with the 10-minute chart, 15-minute charts, daily charts, whatever type of times that you have. So when you think about time trading or time frame, you're thinking about these numbers. But I think there's a lot of difference on time frame trading or understanding trading time frames on a whole. I think there's a lot of difference in it. When you look at the 5-minute chart or the 1-minute chart, you get an understanding of how many minutes does it take for one of these candles to open and to close by itself. So a 5-minute chart takes 5 minutes for its candle to open down here and pushed all the way up to the top and closed over here. Now 1-minute chart, obviously, same thing. It takes 1 minute for each of these candles to bump around, and so forth and so forth. So when people think about time frames, they're only relating their trades to this. They're saying, well, I trade the 1-minute time frame. I'm only looking at 1-minute candles. I trade the 5-minute time frame. I'm only looking at 5-minute candles. But that's not the only thing that time frame really encompasses. There's a whole more to time frame and what it really means, and I think that it should be understood that it's not just about a 5-minute candle or a 10-minute candle or a 15-minute candle. I think it has to do with so much more, and a lot of things that people don't try to associate with time trades that they're or time frame, sorry, that they're missing out. And so let's kind of get into some of that. So I think as far as which is the best time frame, if you're looking at just the minutes or just the size of candles that you're using, I think it's impossible to really answer that question properly because every trader really does have a different personality. You would find that a trader that's more relaxed maybe wants to use a bigger time frame. A trader that maybe wants to sit back and not be staring at their computers every single minute, or a trader that can understand that charts pull back and they're allowing things like that to progress. Those traders may want to use a bigger time frame, even though they are a day trader. They may want to use a bigger intraday candle or intraday time frame to kind of capture the entire move. Now, if you were trading this chart, this exact chart, say on a 1-minute time frame, you may would have only captured this move here or this move here, just because every certain, if I can blow this area up a bit, you'll see now how a 1-minute time frame would have, okay, fine, I go long over the 1-minute opening range breakout and it puts me at a $35.20 long entry. Chart comes up to here, I see a huge bearish engulfing, I'm out. So this 1-minute time frame trader would have made a decent amount because the chart had range. This would have been their trade. Even if this same 1-minute time frame trader came in, was looking at the downtrend being broken here and took the chart right into this range over here, a 1-minute time frame trader would get in and probably get back out there, and so forth and so forth. You would see that there would be numerous times when a 1-minute time frame trader would be able to in and out of this chart for the entire duration of the day with a lot of flag breakouts to the upside. Now here we are with a 2-minute time frame trader. So this person may have gotten some of the moves that maybe were a little bit bigger. And so let's move this out. Actually, let's circle these. So these are just, we're just kind of saying these are the 1 minute traders, right? The 2 minute time frame trader would have probably got into the same spot, but would have probably gotten out here. So at least the 2 minute time frame trader would have probably caught a little bit bigger move, and so he would have, that's a horrible color, and so he would have gotten himself with maybe a little bigger move from here to here. Now if you opened up the time again to a 5 minute trader with the same entry situation, which is open and range breakout, so each trader that takes or trades that individual time frame takes a breakout for a different time frame, right? A 1 minute takes a breakout over the 1 minute candle. A 5 minute takes a breakout over the 5 minute candle. So he gets in here at 35, and maybe he doesn't sell all the way till here, so right about here. So this time frame trader that started over here, now this guy is with a 5 minute chart. I need to get some more colors. Okay, here we are. And so he probably didn't get out till here because the chart broke there. Now the person that's relaxed and the person that's got a 15-minute time frame are still in the trade, because they wouldn't have had a real reason to get out of the trade because it never actually broke any serious areas to get you out. So in this one chart for the 1 day, you can see how a smaller time frame trader would have gotten in and out of the trade continuously. A bigger time frame trader would have probably gotten a bigger move, and then you have a much bigger time frame trader that would have probably still been in the chart because the chart still didn't give you a reason to exit. And so these are just examples of actual times of the day, 5 minute, 10 minute time frames. Now there's also what I like to call reversal times, and I mean I'm sure that's pretty much a good common word out there. Reversal time trades. So I use a 5 minute time frame to trade with, and for me reversal times come in usually about 10:30 to 11. So what I look for is at that time of the day, I feel like it's a good spot for me to look for pullbacks, and in a strong chart I'm looking for a pullback to long into, and in a weak chart or a chart that's coming down, I'm looking for a pop to possibly short into. And so that time of the day for me is about 10 to about 10:30 to 11. Around that time, I find like most charts would have that reversal place, and you can see into that time of the day. If you go through a few charts, you can see into that time of the day how charts do react differently around that time. And now, so the webinar is based on time frames, but this could be a time frame also. This can be a this can be something that you look at to trade differently. Something that maybe goes up, something that maybe is too up and you want to take a short position, something that's maybe too down and you want to take a long position. So there are as far as with understanding time frames, there are also time reversal trading areas in the day where you should also note as a trader. Um, there's also moving averages to consider as far as your time trades. Now, moving average, lazy boy, yeah. If we can go through a lot of charts and you'll see reversal times. You'll see that, I mean, this one is on the dot. 10:30 was right here into this red candle. Perfect reversal time. We can go through a whole bunch of charts, and for the most part, we'll see a lot of them that actually has good reversal time trades. Okay, and so um, also when you're looking, and I just want to keep up ESPR a little bit because it's a pretty open chart and it gives a lot of good examples of what I'm trying to say all in one chart. Um, there are also moving averages that you look at. So everybody has a moving average that they have up in their chart. Some people have the 9, the 21s, the 8, the 13, like I do, the 50, the 200. Now, what do these moving averages really mean to you? Are they just something that you have up in your chart so you can use as a reference? Or do they kind of relate to you, the type of moves that you're looking for? If you're talking about a 13 EMA or 13 SMA or whatever, it's a 13-day moving average. 13 days of gathered information, calculated information. If you're looking at a 50, it's the same thing. 50-day moving average gives you 50 days of information. A 200-day moving average gives you 200 days of information. So isn't that, if you can break it down a little bit, isn't that some form of a time frame also? So when you take a trade off of a 13 EMA or an 8 EMA, you understand that that time frame is smaller. If you take a trade off the 200 SMA, if you're looking at a daily chart, and you take a trade off of the moving average like that, you should also understand that the results that you get from using a moving average like that will not be as quick. Sometimes they might, sometimes it might be aggressive, but the moving average that you're using is also a time frame. It's you saying, well, okay, let's throw some charts on the daily chart and let's see what kind of results we can get. Okay. Okay. Let's look at ESPR for example. If you were using a reference of the 200 SMA when the chart crossed over the 200 SMA and brought this chart down into this range, you would have gotten one hell of a move. Now, if you were only using the 200 SMA as a reference for your entry into the trade, you'd still be in the trade because the chart never crossed back that same time frame that got you into the trade in the first place. If you were using an 813 crossover, I guess I gotta blow it up a little bit so you can see. If you were using the 200 SMA, for example, you would probably have gotten in about $14 over the 200 SMA. If you were using the 813, you probably would have gotten in a little bit cheaper, maybe a point cheaper, at $13. The difference is, if you were using an 813 crossover, which is my strategy, you would have gotten stopped out here. If you're using the 200 SMA as your strategy, you'd probably still be in the trade. If you're using a 50 EMA as your strategy, you would have gotten stopped out about here. So the trade would have made all this way up and then stopped you out here. So you would have made more money than me at the 813, and you would still be in the trade if you were using the 200. So what I'm trying to say is, obviously you can see how the moving averages should be used appropriately when looking for trades. Now this is just a daily chart reference, so you can use that in application to your intraday trades also. I use the same moving averages during the day, and they apply the same way on a different smaller time frame. If you're doing AAOI using the 200 SMA as a long set, where would you have been long on this chart? All the way down here at 15, long over the 200 SMA on AAOI, and you'd still be in the chart because your moving average keeps up with you and it moves upwards as your price is moving up. So that means your stops move from here to here. But yes, that's a huge wiggle room, but that's just the way that it works. If I was using an 813 crossover to get into the trade and I got in at the same spot, I'd be out here. So I'd be in at 15, out at 21. I could have been in and out of this trade a couple times with the 813, but never for the duration of the move. If I was using a 50 EMA, I'd be in over here, less, because that's where it crossed the 50. And then I'd probably still be in there. I'd probably be out there. Sadly enough, I'd probably get back in and then come back out here. But you can see that I'd have different entries and exits on a 50, and then I would have So my smaller time frame, my 813s, I'd have little bumps like this. And then on my 50, I'd have little bumps like this, where I'm in and out. On the 200, I'd still be going. So now, in reference as far as time trades goes, or time frames, you can use them for your swing trades also, because this is a time frame that you're using. The estimated average time that you want to get into the trade, and the estimated average time that you want to exit the trade, are reflected a lot on the moving averages that you use during the day. If you took AAOI on a 5-minute chart during the day, long over the 200 SMA, you would still be in the chart because it's still over the 200 SMA. If you took it long over the 50 EMA, you probably would have gotten out here on this one intraday long trade. If I was using my 813, here's the difference. When I'm day trading using the 813, it gives me a lot quicker entries and exits than any of these moving averages do. Reason why I prefer to use the 813 is because I'm more so a day trader, right? And so once I'm entering that position on a day trade position, I want to try to maximize as much of the potential of that chart that it has. I mean, at the end of the day, your job as a trader is to try to take money away from trades. Try to take money away from the market. That's your job. And so what you're doing is you're trying to enter a trade using a certain time frame moving average and trying to exit that trade in an appropriate time. Now, if you use the 200 SMA, you'd have to still be in because the reason you got into the trade never voided itself, and you would still have to be into the trade. If you use the 50 EMA, you would probably be out, or you would have still stayed in because the chart really didn't strongly or aggressively take you out of the long trade. So here you are with time frames as far as 5-minute charts, 10-minute charts, 15-minute charts, time frames as far as reversal times of the day, where you're looking at that 10:30 coming into the afternoon. You're looking at that 2:30 for that other timed trade reversal, and then you have your moving averages, your smaller moving averages that will get you quicker ins and outs, and then you have your bigger moving averages that are going to get you into the duration of the trade for a little bit. Now, if you're just using candlesticks, then that's obviously going to be reflected on your 1-minute, 5-minute charts or whatever. So that really doesn't matter. If somebody says, well, I'm only using 1-minute candlesticks, well, then you're on a 1-minute time frame. And that's the kind of personality that you have. Maybe you need to take quicker trades. Maybe you need that excitement during the day. Maybe you need to be in a whole bunch of trades at the same time. And so those types of traders have different types of personalities. It's usually a more aggressive, usually a more of a, I don't know, a non-trusting type of a time frame. For me, I consider that a non-trusting type of a time frame, because when I get into a move, sometimes people will say to me, "Hey, you've given back up so much of that move to see it work, and that's I'm happy that your chart worked for you." But why would you allow it to come back so much? Well, it's because of the time frames that I use. Now, when I look at a chart, my trading chart, I trade off the 5-minute, but on my side charts, I am always working with different time frames. I'm always working with bigger charts so that I can see what the charts have done. So 5-minute, 1 day. What do I know on AAOI? I just know what's going on today, right? But on my side chart, I have a 15-minute time frame. I have a monthly time frame. I have a 30-minute time frame. So just on one trade, on one chart, I'll have all these different, obviously they're all linked, right? So they'll all switch up at the same time. And that way I can see, well, okay, here's my 5-minute time frame. That's what I'm looking at. But what can I see on a bigger time frame? Can I get a continuation off of this? Is this a position that I can hold longer? Is this something that I can overnight? So that'll give me a bigger time frame look there on the 30. The daily time frame is going to tell me a lot of stuff. When you're looking at a trade and when you're in the trade, sometimes you get to a point in the chart where you just can't go through and you just can't figure it out. So what do you have to do? You have to use your same time frame that you're in, or same chart that you're in, and you have to move this and open it out to a bigger time frame to look at where the chart's at, to see what it's doing. But what if you had a chart up on the side that you could have seen this, that you could understand that what the chart is doing before you have to take a minute to go back and take a look at it. So what I'm trying to say is that as far as time frames, I have 4 of them open at any one point on my trading platform on any chart. So whatever chart that I click on, I'm ready to see it now. I'm ready to see it 2 days from now. I'm ready to see it in a monthly. On a daily. So I think that a lot of people get into trades and they don't allow themselves to see a bigger aspect of what's there. How many times have you taken a trade, intraday traded or whatever, and then you leave so much on the table? And why are you leaving so much on the table? The reality is that you're not being able to see more than what's in front of you. If you only trade this chart on a 1 minute time frame, you'll probably be excited to catch this move from here to there, right? Entry, exit, maybe entry, exit, maybe entry, exit, right? And so when you open it out a little bigger, you'd see that, oh wow, well, I could have just stayed in for the whole day. Or what about if you traded on a 15-minute time frame and yesterday's move, right, from the top, the pullback, the projection, you can see that you would have been able to capture a much bigger move on a bigger time frame. Now, is it wrong to use a 1 minute time frame? Of course not. Is it wrong to be a more so of what we call a scalp trader? No, of course not. You do what you need to do. You be consistent or try to make money as best as you could do for what your purpose is. Your purpose is basically to try to make money. That's your job, right? That's why you're here as a trader. You're here to try to make consistent gains so that you can provide for your family and do what you need to do in life. Now, if you feel more comfortable doing that with a smaller time frame, of course you can do that, and I don't see anything wrong in that. I don't ever feel like it's wrong to do that, but I feel like there's a bigger potential in a lot of trades. And when I get into a trade, sometimes I'll be in one trade from 9:40 in the morning till literally sometimes till about like 3:45 or 3:50 right when I'm closing it out, because the chart never gave me a reason to get out. Sometimes I'll get out of the trade only because either it's a very expensive chart and I don't feel like I want to overnight it, or it's a volatility chart, it's commodity related or something, and I don't want to go through that. But for a lot of times, there are a lot of times when I'll overnight stuff, and I'll overnight a position or a piece of a position because the chart never, at the end of the day, gave me a reason to get out. And so the only way that I could have seen that is by having these small little side charts associated with my trading platform that I can see the move that could have a bigger potential to it. Now, let's look at Labu, and we'll take a look at the moving averages and how you can get yourself into a trade and stay into a trade for a little bit longer. When Labu pulled down to the 200 SMA a few days ago, a couple weeks ago, I brought it up as for a swing trade. There were a couple people that took it, and I don't think any one person has it at this point. But here we are off the 200 SMA, and did we have a quick reaction off of that? Yeah. And that's not normal. That's not what you usually get off at 200 SMA. You usually get a slower grind, a kind of more relaxed play. But then again, we've had a lot of biotech volatility. And so the chart just so happened to come off the 200 SMA on this trade and really kind of rock it. Um, but if you're using a 200 SMA, you have no reason to get out of the trade. Is it extended where you'd have to scale out some of your position? You definitely have to shave off some because it is getting extended to the top side. But time frame related, there's no need for you to jump out of that trade. You really have to be able to understand the moving averages that you're using and the results that you're trying to get out of it. Um, you can't be a 1 minute time frame trader and complain about the move that you didn't see or didn't get later on during the day when the chart actually moves. You can't complain about that. You can't say, well, I should have gotten this or I should have gotten that. I should have seen this happening because it really wasn't the type of trade that you were setting yourself up for. It wasn't the type of trade that you were trying to do. And so you have to understand the capabilities also of the times that you're trying to trade with. You want to trade with time frames that are really going to give you something that you can really benefit from. My throat is really sore tonight. Um okay, so as far as time frames go, as far as trading time frames themselves go, I think it really needs to be broken down a little bit more. Um, I think you as a trader need to understand what you really want to get out of this. What kind of trades are you looking for? Are you looking for that quick trade? Is your personality more associated with a trade that's in and out, or is your personality more associated with a trade that can give you duration, can give you continuation, and then so you can't be you can't be looking at a small time frame trade and be upset later on that you didn't hold it. If you're looking at a small time frame trade and you're playing a small time frame trade, try to stick with that. Don't blame yourself for don't blame yourself for not holding more. If you started off small, you started off in a 1 minute time frame, a 2 minute time frame, and you get out because that time frame tells you to get out, then get out. That's your strategy you got in with. If you take a trade for a bigger time frame and it pulls back on you, but the strategy that started you off with the trade still keeping you into the trade, then stick with it. Try not to discourage yourself. Don't look at bigger time frames first and then try to break down the charts after. Look at smaller time frames to get into and escalate the time frames up. Expand them upwards, not downwards. What I'm trying to say is you don't look at a 15-minute time frame on this chart and say, well, I want to get in here, but I want to exit on a 5 minute. So that makes no sense. But you could start off on a 5 minute and then you can open it up to a 15 minute to see the bigger picture. So you can't look at a daily chart looking for a swing trade. You can't look at a daily chart and say, well, I want to get in here. Okay, fine. You want to get in here. You want to get into this trade on a swing because you think it's going higher. Let's bring ESPR up a little bit. You want to get into ESPR because you think that this trade's going higher. Do I think it's going higher? Hell yeah. That's why I had it for a swing in the first place. So I want to buy it off the daily chart. Good. I buy it off the daily chart. Fine. I bring it back into the intraday chart and I'm worried. I'm worried now because I bought it here, wherever if tomorrow it pulls back. But the chart's down here and now I'm stressed out because I bought the chart on a daily and I'm looking at the trade on an intraday, which makes no sense. If you buy it on this candle frame, you stick with that candle frame. That one's a lot big. It's huge. That one's a scary one because the risk to the low of that day is an interesting place to be in. I wouldn't do it there. But if you buy the chart looking at this time frame, you got to stick with this time frame. You have to. You can't buy it there saying, oh, I want to swing ESPR because it's going higher. I think it goes higher. Sure, it goes higher. Fine. We've kind of discovered that we feel like it goes higher. Good. Now where do you want to get it? Okay, I want to buy ESPR because it's going higher. Fine. So you buy ESPR tomorrow during the day. Chart continues to pull. You get out of the position. But you started looking at it for a swing, but you sold it because intraday it's pulling back a little bit too much. So then what was your misdoing there obviously was understanding that you want a swing trade, which is a bigger time frame, but then you're looking at it in a smaller time frame and confusing yourself. You're only really confusing yourself a lot when you do stuff like that, because what you desire to get out of it is a swing. But what you end up doing with yourself is you're complicating your strategy. Your strategy mentality going in was I wanted to buy ESPR long for a swing because of that time frame. And then you come intraday and the chart's pulling back a buck on you and you're complaining that this chart's failing. It's not working. The swing's no good. But you don't understand that your reasoning for getting in the trade and your reasoning for now exiting the trade is two completely different things. When I look at my swing trades, I only look at them on daily time frames because that's where I got into it. Why I exited ESPR is because I was using the 50 EMA on the daily chart as my stop out basis. So I needed the chart to stay over the 50 EMA, and the day it closed under the 50 EMA, I had to exit the trade. So I ended up on this swing trade leaving about 8 points on there. But the point is that if I'm looking at the trade on a certain time frame, I have to stay with that trade on that time frame. And if you're trading intraday on a certain time frame, try not to change your methods of entries. You can open up your time frame as far as trying to get the bigger move, but try not to damage the strategy by switching up. Like for example, I don't want to be trading during the day most of my charts on a 5 minute, and for some reason I just want to start a position here on a 1 minute time frame during the day. Then that just really messes me up, because you know what happens when you switch up your time frames. Look, any chart can look good on different time frames. I can be looking at ESPR on a 1 minute time frame during this time of the day, during this time of the day, during this time of the day, and saying, well, that chart's done, it's gone. I could be looking at this chart on a 5 minute time frame and said, well, it was a good run, but that's enough for me because I got stopped out here. I could be looking at this chart on a 30 minute time frame and I could be saying, well, maybe we just started, so maybe I'll keep some. I could be looking at a chart on a daily. So what I'm saying is that every single different time frame that you associate yourself with as a trader, you have to be able to trade that time frame. Get into it, stick with it, and understand it, but keep it yours. Make it yours. If you're comfortable with the 5 minute like I am, then play with that. If you're comfortable with 15 minutes, then play with that. But the strategy that gets you into the chart has to keep you into the chart. You can't just jump around all over the place. I use my side charts, wider time frames, to justify me, keep me in the mentality of, yes, I want to stay in because I feel like there's something else coming up bigger. The bigger time frame is telling me this pullback is justified. Maybe my 1 minute time frame or 5 minute time frame is telling me this pullback's a lot, but maybe my 15 minute time frame is telling me this pullback is okay. I can handle this. I can stomach this. And so a lot of times, a lot of traders, when I trade, they'll say, well, hey, what happened? You know, why'd you let it pull back so much? And it goes and it works, but why'd you let it pull back so much? And I'm saying, well, because I'm using a bigger time frame to kind of capture the entire move. Sometimes even the bigger time frames might get you in a little trouble. And that's a risk you take, though. If you understand that you're trying to get a bigger move, sometimes your pullbacks have to be bigger. And so when I do a pullback, and sometimes a pullback fails, as with every trader or trade that you take out there, there are a lot of pullbacks or a lot of charts that fail. And so sometimes I wait for a bigger time frame to actually pull back and to actually do what it needs to do, and instead of holding, it fails. But and I'll end up giving back a lot more than I wanted to, but I understood why I was keeping it in the first place. So sometimes a bigger time frame, when you're trying to allow for a bigger move, you have to you have to give back some of that bigger gain in order to capture a bigger move. And depends on your personality. If you're a relaxed person, if you're calm, you'll sometimes find yourself using a bigger time frame or being more of a swing trader. Um, and you'll find yourself being less aggressive, less wanting to do 1 minute time frames and 2 minute time frames and stuff like that. Remember, you have so many different time frames out there that really any strategy can be made up by using any time frame and any moving averages that you want, any indicators that you want to use up. I think there are too many strategies out there that are that are or how should I say too many? There no I think there could be any amount of strategies out there. I really don't think there's one golden strategy. The thing is that how you work with it is really what makes it good or bad. Um, you really don't have a best strategy out there. I don't think my 813 is the best strategy out there. No way, because I can do a 915 and it'll still be a good strategy, right? It's not the exact strategy. It's how you go about doing it, how you go about trading that strategy that you want to use. And so when you're using the time frames, it kind of works the same way. You want to keep switching up your time frames because this trader is using that moving average and this trader is using that moving average. Well, you're not that trader. You're not using a 200 SMA for a swing trade. Why? Because you're not a position trader. Unless you're holding a position, a trade, trend trading, position trading, they're both kind of the same thing. Um, unless you're holding that position for more than a month, you're not a position trader, and you shouldn't be using a moving average specifically designed for a much bigger trade or a much bigger time frame hold. If you're using a smaller moving average like a 50, then maybe you get a quicker bounce. So if you're using a moving average like an 813, even on a daily time frame to get your swings, you expect those swings to react a little faster. So understand the parameters of what your capabilities are. It when you see traders using certain time frames and you feel like you want to do it, you feel like you could do it. So I want to trade stuff off the 200 SMA because I see big traders working with it. Yeah, big traders like big traders have the capabilities. First of all, you have to have a certain account size to hold a certain position a certain amount of time. So first of all, they have probably that cash flow that will allow them to stay into this position for 2 or 3 months. Do you? That trader may have the I don't know, the capabilities of stomaching some of that pullback, the big pullbacks, the ones that you'll cry about, the ones that you'll heard about, the 2 or 3 point pullbacks on a big move, the ones that you can't stomach. And so can you do that? And so when you're looking at other people's strategies and other people's time frames, it has to apply to you. It has to work for you. And if it doesn't, then what's the point of using it? What's the point of looking at it or caring about it if it doesn't apply to you? If it can't make you money, then why do you care about it? Find something that makes you money. Find something that works for you. Because if it's not working for you, if it's not making you money, it's not all the time, and sometimes I believe it's never the problem with the strategy. It's never. I don't feel like it's ever a strategy problem. I always feel like it's an individual problem. Um, if you're gonna say I'm gonna play the 813 and you see an 813 and you don't take it and the trade goes and the chart goes up if you're long and you didn't take the trade, was it the strategy problem that kept you away from the trade? No, it was your trouble. It was your problem that kept you away from the trade. If you say I'm gonna long things over the 50 EMA and the chart's over the 50 EMA and you don't want to take it and the chart goes up, was it the strategy that was the problem or was it you? So I firmly believe that it's never the strategy that you're trying to use as problems. It's never that. It's you as the individual. So associate yourself with a time frame that can purposefully give you something, a result that's beneficial to you and the time frame that you have to be realistic about stuff. Get a time frame that realistically applies to you. If you want to use a 5-minute time frame, but you want to be a scalp trader using a big time frame, that's too big for your purpose. If you want to be a swing trader, you're looking at the 15-minute chart continuously during the day, you're not a swing trader. You're not looking at the things the way that you should be doing it. So understand what time frames you're trying to understand what you're trying to get out of your trade and what time frame is best dedicated to that. But don't try to intertwine them too much. When I open my swing trade account, I have a separate account for swing trade just because of this reason. I have a separate account, sorry. I have a separate account just for this reason. When I open my swing trading account, I rarely ever look at it other than a daily time frame. I'll make sure, I'll open it up. It'll save as a daily, so it'll open as a daily in the settings. I rarely ever try to look at the intraday. If, say, for example, I was in this one, which I was, sadly. If, for example, I was still in this one, I would have to open the daily. Have to. The intraday. I'd need to see where that close was. I'd need to see the kind of volume that came in into the close. I'd need to see if buyers were stepping in. So I'd need to see things a little bit in detail, because obviously a chart that goes up that much, if you were swinging it, you'd have to shave off some of that chart. And so in a trade like this, I'd have to open it. But if I was in a regular trade, I feel like I never ever need to open it. Keep an eye on AAOI, by the way. I think the chart's ready to make a move, so might be tomorrow. But so can I use the 50 or the 200 for day trading purpose? I'm pretty sure you could. I do all the time.